Hey there and welcome, guys. This is Josh Cantwell, and this is Strategic Real Estate Investor Radio. Thanks a lot for joining us again today. My name again is Josh Cantwell, CEO of StrategicRealEstateCoach.com, one of the nation's leading providers of education, training, and resources for real estate investors looking to accomplish their goals and objectives in today's real estate market. I'm really excited because actually just this past week, I want to thank everybody because just this past week we hit the main page in iTunes as in their news and noteworthy section. And for those of you that have your own podcast, and my guest today has his own podcast, those of you that do know that's a big deal. Not only were we on the news and noteworthy section for the investing category, but also on the main page of the news and noteworthy section in all of iTunes. In their podcasting universe. So I want to thank all of our listeners and all of our subscribers and members for listening, downloading our podcast, giving us a 5-star rating, leaving us reviews. It's really the only way we get there to be news and noteworthy is because of you and because of your feedback. So we greatly appreciate that. What we try to do here on Strategic Real Estate Investor Radio is give you great real estate investing advice. And actually, my guest today is my friend Joe Fairless, and Joe is a beast. He has his own podcast. He's got 350 episodes, does a daily podcast, and that podcast is called The Best Real Estate Investing Advice Ever. So we're going to be hearing from the guy who's given out 350 different interviews and segments or little nuggets of great real estate investing advice on his own podcast. So we're hoping to we're just hoping to glean a little bit of that out of you today and get some great real estate investing advice from you. So welcome.
Awesome. Well, thank you, Josh, so much, and congrats on the new and noteworthy category and success with your podcast. That's great to hear and well deserved.
Awesome, Joe. I appreciate that. So Joe has been a real estate investor for a while. Built a $7 million real estate investing business. Joe is also, I'll give you some color about his background. He left his sort of cushy vice president position with a New York advertising firm, was the youngest, one of the absolute youngest VP level New York City advertising executives. Has a lot of experience in both branding, marketing, advertising, real estate investing. So just got a lot of different things that we could talk about. But before we jump down to start recording this live, Joe and I really kind of dialed in. We have some things that we really like to do and that are really kind of synergistic between what Joe likes to do and what I like to do, which is talk about money and raising money and getting the funding for your real estate deal. So Joe, before we jump into syndication, syndicates, and kind of how to make the leap from single family to multifamily real estate investing, why don't you just give us a little bit of color about you, about your background, and the transition, because I think everybody's always interested about the transition from a full-time job into real estate. How does somebody make that transition? So just give us a little bit of color about you and your background and your transition.
Yeah, sure. So I am from Texas, and after I graduated from college, I graduated 2005 from Texas Tech. I moved to New York City and spent a decade there. I actually now live in Cincinnati. I moved to Cincinnati about 3 months ago, so we're kind of neighbors now, with you being in Cleveland. So I lived in New York City for a decade, and I climbed the ladder, as you mentioned. I started out as a junior project manager at an ad agency, making pretty much less than minimum wage whenever you factor in all the hours that I was working, and then climbed the way up, saved some money, and eventually read a lot of books. And one of them was Investing for Dummies, where they talk about the 3 different types of investing: stocks, bonds, LLCs, and real estate. And then after I read that, I kind of just gravitated more towards real estate, started investing in single-family homes from New York City, but investing in properties where I was from in Texas in 2009, and I just lucked out. because I started buying in 2009, not because I was timing the market perfectly, but just it was just dumb luck. I didn't have any money until 2009, and that's whenever I started investing. So fortunately for me, I was buying homes at a pretty darn good discount in Dallas Fort Worth in 2009, and ended up buying 4 homes as buy and holds from 2009 to 2000 12-ish. And I still had my full-time job. And as you asked, kind of what was the transition like? Well, it was a slow transition because well, relatively so. It depends on kind of our time frame. But I started learning real estate investing in 2006, and then in 2012 I left. So that's 6 years, and in between those 6 years, I was studying. I was also, after I started buying the homes, I was living in New York. My friends were like, "How the heck are you buying these homes in Texas and just not going there and visiting the properties?" And I never visited a house before I purchased it physically. I didn't, and in fact, I've only seen I don't know, out of those 4 homes, I've only seen them maybe 2 or 3 times total. One of them never in person, even though I go there for the holidays. Um, and and so I started teaching a class in New York City through a website called Skillshare. And at the time they had in-person classes. So I started teaching classes, and the more I taught the classes, the more I was like, this is kind of cool. I enjoy this. But once I realized that advertising wasn't for me, I'm a huge Tony Robbins fan. He talked 6 human needs, and I won't go into all 6 of them, but the last 2 lead to fulfillment, and that is growth and contribution. And I wasn't feel like I didn't feel like I was growing, and I didn't feel like I was contributing in advertising anymore. I was before, and not to say that we can't. That's just not how I'm wired anymore, or it wasn't how I was wired anymore. So I identified that real estate investing was something I wanted to do, I could do more of, and kind of grow and contribute and learn. So I left, but once I left, I realized that, well, shoot, I can't get approved for a mortgage because I don't have a stable income. I have, like $250 from a house coming in every month, but that's nothing. That's not going to get approved for anything. And single-family homes just aren't cutting it from a financial goal fast enough for what I want to accomplish. So I started studying multifamily, and I guess I started studying in October of 2012, and I left in December of 2012, so a couple months before I left. And then I learned studied how to raise money from investors, and closed on my first syndicated deal, 168 units in Cincinnati, in July of 2013.
Fantastic. So, guys, that's the transition, right? You got a young guy out there, hungry, graduating from college, making below minimum wage to start out, busting his chops, working lots and lots and lots of hours, starts investing in real estate virtually, buying properties he doesn't even see, jumps in, starts raising money, learns about syndication, raising private money, and takes down a 168-unit multifamily building, right? So, guys, that's how it's done. And Joe would probably tell you, like most people do, look, I just got in and took action. I learned, but I took action. I didn't just learn and learn and learn and learn. So, one of the best pieces of real estate investing advice that I could give everybody who's listening to this would be, don't just continue to attend free webinars, free classes, free podcasts. You got to go do it. You got to go actually get off the couch, get up, get in the field, and actually start making offers. Start making offers. That's where it really starts. And you'll be surprised, blown away. Sometimes you might have to make 2 offers and get a deal. You might have to make 30 or 40 to get a great deal. But unless you make an offer, nobody's going to know that you're a real estate investor. That's where it begins. So, Joe, thanks for the background and a little bit of color about you. That's fantastic. Joe, what would be, let's start, I really wanted to talk, we talked about just kind of 2 things we really wanted to hit on. One is the leap from single family to multifamily, like you just described. And then second is this concept of syndication, which again you just touched on, to fund larger deals. So Joe, where do you want to start? Do you want to start with syndication first and then back into the transition, or do you want to start with the transition and then talk about syndication?
I think we can talk about the transition and then evolve into syndication.
Got it. Perfect. So, a lot of my subscribers that buy my products, Joe, like our Freedom Funding class or our 40K Flips class, they're investing in single family. I think everybody thinks I want to buy single family to make an income, and then I want to buy and hold commercial for long-term wealth accumulation and to create cash flow. That's what I teach my members, and that's what I'm in the process of doing as well. So what's your take, Joe, on that transition? If somebody is a single-family home investor today and wants to get into commercial, what does that mean? And I think the first thing, Joe, if you could address would be the mental part of it, because a lot of people think commercial is just too big and hairy and scary.
Yeah, I think the first part is that I thought going from single to commercial, because I had 4 single-family homes, I was kind of walking in very confidently, and I thought whenever I was meeting with brokers that I would be at the top of their list because, and this is so stupid of me, but I thought, well, I've closed on 4 homes. I'm a proven trigger puller. Now I want to buy an apartment building. Here's who I am. Here's my background. But what I found out is that they want people who have experience in multi. So the fortunate thing is, going back to your question about the mentality and the mindset. Well, everybody started in the same place, right? Everybody started not having purchased one. Doesn't even matter if you grow up in a family that's been in commercial real estate, you eventually are going to buy your first place. So how I was able to overcome the challenge of not having experience in the commercial space, which everybody who hasn't purchased something will have to overcome, is I simply surround myself with people who have that experience. And first and foremost, I think it's having, well, I'd say at the top of the list, there are two entities or 2 groups or 2 people that are tied for first. One is a local management company. If you're not managing it yourself, if you're buying it out of in another market, or if you are setting your real estate empire up for a business and a company and not necessarily another job, then you'll want to have a third-party management company or create your own management company. So having a local partner in the market is critical, because then whenever you say, oh, well, I was speaking to, let's just pretend that, Josh, you've got a management company. I was speaking to Josh's team in Cleveland, and they're going to be handling the management for the property that I purchased in the next 6 months in Cleveland. Well, that statement is going to go a lot. It's going to give us a lot of credibility and go a long way to establish ourselves in the mind of the broker, because the broker's like, okay, so he's talking to a credible property management company in Cleveland. And Josh, I know your special sauce isn't doing property management in Cleveland, but just for this example,
I know somebody whose is, though.
Yeah, exactly.
A good friend of mine, his actually ex-wife, who's still very good friends, is a huge property manager in the market. It's called ISM Management in Northeast Ohio, and I think they manage like 400 or 500 units, a lot of single family, and a number of small multifamily. So I do know those kind of folks. It's not my specialty, but I certainly know people who it is.
Yeah. So you name drop the ISM property management, and then you're able to have a credible conversation. The second person or entity tied for first is a consultant, or at least modeling after somebody who is willing and able to give you their expertise and answer your questions on an ongoing basis. It's a must. We can read all the books, listen to all the podcasts, and and participate in as many forums as possible. But eventually, you're going to need somebody who is there to help answer the questions that you have during the unique aspect of a particular deal. So I align myself with a management company and with a consultant, and then with those two, I was able to make the transition from single to multi. In addition to just the tremendous psychological expansion of my mind whenever I was looking at apartments. Because originally, this is interesting. I was looking for a 30-unit building as my first purchase. Because psychologically, going from singles to a 30-unit, that's a big step.
Sure.
So I was looking at 30 units in Tulsa, Oklahoma, but I couldn't find anything, and I went to Tulsa, Oklahoma to show that I was very serious about it, and I ended up speaking to some brokers, and we made like 8 or 9 offers on properties. Nothing came through. So I was looking at like $1 million price point. I thought I could confidently raise about $300,000 to $400,000. Well, not confidently, but I was blissfully ignorant, thinking I could raise $300,000 to $400,000. And what happened is my consultant ended up coming across a deal in Cincinnati, the one I closed on, the 168 units. But the challenge was it was 168 units, not 30 units, and instead of 3 to 400, I needed over $1 million, and I'd never raised a penny before. But with the support of the team around me, I grew into the deal, and there's no way in hell I would have ever selected a 168 unit to do my first deal. But after I got so familiar with the 168 units after evaluating, I was like, there's no way in hell I'm going to go lower than 168 because
Right.
I'm past that. I was mentally past it. I think that is a big part of it is playing in the big leagues with the big league players and having some allies on your team who are at that level so that you can go in with eyes wide open intelligently and make it happen.
Well, Joe, that's great, and I appreciate the advice. And for those of you who are really paying attention and kind of taking notes, what Joe said again, align yourself with a consultant that understands the commercial market. Align yourself with and get to know the property managers in the area that understand rent rolls, that understand tenant placement, that understand how to manage these large multifamilies. Because again, a lot of times the best multifamily deals are not going to be in your own backyard. And from there, you become familiar with it. When you look at the deal, the numbers are really going to tell you what's a good deal and what isn't. And I think, Joe, I love your case study here because you kind of go in thinking, wow, 30 unit, that's a big deal. I can raise a couple $100,000. But I end up with a 168 unit, and now I'm never going to go any smaller than that, right? It's almost like when you buy a certain, buy a certain watch, you're probably not going to go back to the other kind of watches that you used to be able to buy, right? You just kind of get used to a certain style, a certain color, whatever it is. Same thing with houses. You start doing rehabs on a certain scale, you kind of never go back. You start owning rentals on a certain scale, you never go back. You start owning multifamily on a certain scale, why go any smaller, right? So I like the advice there about your transition. That's great.
Yeah, and I think it's interesting hearing you talk through those examples, especially on the houses where you rehab maybe a small house and you rehab a larger house. Why, looking back on it, and clearly I didn't do the single to 30 to 50 to 100 to I went straight from single to 168. I would challenge your listeners to maybe not go through the normal step-by-step process of single to 30 to 50. Why not go from single to 100? And because ultimately when you poll all the individuals who close on their first multifamily deal, I promise you that 80% of them are going to say their number one regret is that they didn't go large enough. I promise you. 80%, 8 out of 10 will say they didn't go large enough on the first deal. That's the only regret that they have. Unless they bought it wrong, then then that's another story. Then they'll have all sorts of regrets. So how you do that is you follow the three things I mentioned before. Find those who are successfully doing it, get a consultant, and have a local team in place that can guide you. Because whenever I'm underwriting deals, I underwrite them, but then I don't share that with my local team that's going to be managing it. I have them underwrite it as well, and then we compare notes. That way I can see how they're underwriting it and how I'm underwriting it, and then we can see where the differences are and have a discussion. That's one tip whenever you're looking at multifamily deals and you're looking to find a property to buy. That way you don't unduly influence their underwriting and how they're running their numbers, because ultimately if you're not living in the market, they're the market experts. So you should look at what they're thinking the cost per unit per year is, different expenses for taxes, insurance, things like that.
Got it. Love it, Joe. So let's talk about syndication. And we hear the term a lot when it comes to buying a building, raising money, especially larger commercial buildings. Is I was able to acquire the funds through a syndication. And my regular listeners and subscribers and members know that I started a private equity fund, and we make loans to our members who are in certain programs, and they're able to buy, rehab, and sell single family or small multifamily, small commercial, using our funding. We provide 100% of the financing, but we didn't do it through a syndication. We did it through a private equity fund, and we're raising money through what's called a 506B Reg D offering. And so the first fund we did allows us to just raise money from people we already have a prior existing relationship with. That's the nature of a 506B. The 506C Reg D offering, which again, those offerings are you're basically an exception to the having to be a securities dealer, okay, a broker dealer. The 506C allows us to advertise to the general public, but we can only take money from accredited investors. And so we've done both. There's the concept of syndication, using private lender money and several layers of financing to buy big commercial buildings and especially apartments. So, Joe, what's your take on sort of the definition of syndication, and how does that help you raise money for multifamily?
Well, I like to define it using an example that whenever I heard this example, it was crystal clear to me. Everybody who's listening has likely participated in a syndication if you've flown somewhere. Because when you fly somewhere, then you buy a ticket, you get on a plane with other people, and you arrive at the destination that you all chose to arrive at. Same with raising money. For a syndicated deal with real estate, you put in a little bit of money, relatively speaking, to buy something that's worth much more. In this case, a building. In the previous example, an airplane. In that case, you're renting an airplane. And you're able to arrive at the destination that you want. In the real estate example, it's your financial goals of whatever the projected profits are. So all a syndication is where you raise money from individuals and you participate in something larger, and then you all share in the benefits, much like an airplane, much like in this case real estate. So how I use it is with the investors that I have through my network, we do just that. If I find a deal, and whenever I find a deal, we underwrite it. Me and my team underwrite it, and we put a presentation together and speak to people who I've already spoken to. That's the key for me, especially where I am constantly speaking to my friends and my network about what I'm up to and learning about their goals, so that whenever I do have a deal, I'm not scrambling, because I did have to scramble on my first deal, and it wasn't a fun experience at all. where I didn't have any money raised and verbally committed. Yours is obviously different because it's a fund, so you've got the money up front, I imagine, and then you're
Right.
just allocating the money based on whatever comes across, based on predetermined criteria that you've established. Whereas I do it a deal by deal basis, and in order to do a deal by deal basis, I actually have to have the deal to raise the money. So what I do to generate interest for my investors prior to that happening is I simply have conversations with them. I ask them about their financial goals. I learn about their financial goals, what they determine success looks like with their investing, and once I know that, then I can see if we're a good fit for a syndicated deal. And then I ask them, if I find something that meets your financial goals, would you like me to share it with you? Everybody said yes so far. They'd like me to share it with them at least. And then when I find something, I keep them updated along the way as I'm searching for something. And then when I find something, I let them know about it. And then they end up investing in the deal.
Yeah, that's fantastic. You know, that reminds me of Joe is Warren Buffett, actually. When Warren Buffett started Berkshire Hathaway, it was much like a syndication. He put a little bit of his own money in and was able to prove to his investors through his stock recommendations, and he was able to retain a large shareholder interest in Berkshire Hathaway, while everybody else put in all the money. And because he was the one basically with the ideas of what stocks to buy, and he had a track record of the performance of the stocks and the companies that they were purchasing, everybody else wanted to put money in. So he basically contributed the intellectual capital, if you will, and they contributed the monetary capital. And sounds like you're kind of in a similar situation where you might be contributing a little bit of your own monetary capital, but what you're really doing is you're kind of the ringleader. You're contributing your intellectual capital to find the deals, vet them out, underwrite them, and produce a good investment opportunity. And everybody else is producing the monetary capital. And of course, you probably retain a large portion of the total control of the deal and the total ownership because you're the one that sort of originated the deal. Does that sound right?
Yeah, exactly, exactly. They're passively investing in the deal, and I'm quarterbacking everything else from finding it to making sure the business model is being implemented to looking at when's the right time to sell or refinance. They have a vote in the deal when or if they have a vote in the overall investment whenever it's time to make big decisions like selling or refinancing. But from the day-to-day standpoint, they're purely passive, and I'm responsible for hiring, firing, property management, increasing rents, doing any concessions, things like that.
Fantastic. So the latest deal that you did, the 168 unit, was that a syndication? Was that a deal that you vetted, underwrote, and then raised the money for?
Yeah, the first deal I did was 168 units. I did that in July of 2013, and then the latest deal was a 250 unit that I just closed on about a week ago, and that was a syndication. It actually came through one of my clients, and he similar to my situation on the first deal where I was looking at smaller, but then I came across a really good opportunity. He was looking at smaller, came across a good opportunity and didn't have the money that he needed to close on it, and it was a very short time frame. He actually needed 2 million in about 2 weeks, or at least 2 million to be confirmed that we could bring to the table in 2 weeks, and then we would need that 2 million in about 40 days. So I said that's a pretty short time frame, but let's take a look at it, and it was a really good opportunity. So I ended up bringing in a partner, and they raised 1.1 million. I raised 1.1 million. We both put our earnest money hard after the 2 week mark, and we kept on raising the money, and we ended up getting it funded and closed like I said, last week with the investors.
Very cool, very cool. when you do a syndication deal, there's lots of different ways to structure it, but a syndication is usually equity financing, right? You're usually giving up some equity in the deal to each of the people who participate in the syndication. I know some guys do debt financing, but that's not necessarily, I guess, my definition of a syndication, because when you're doing debt financing, it's mostly, one person is the buyer, everybody else is just a lender. So in your case, Joe, and most of the time, you're doing equity financing, so they're participating in an ownership position. Is that right?
That's correct.
Fantastic. Yeah, I love that. That's very, very cool. So, Joe, what are you focused on now? I know your podcast, you give out the best real estate investing advice ever, which is awesome, and you're doing these apartment syndications. So you closed on this deal a week ago. What's on your horizon? What's in your pipeline? What are you looking at next?
Yeah, well, right now I'm letting the ink dry on the 250 unit for sure. That was, that took up the last 3 months of my life. But in addition to making sure the ink dries and the business model is implemented in Houston, I'm also just put my 168 units in Cincinnati on the market. So I'm working with my on that and fielding inquiries on the 168 units. So I've got that going on, and then as you mentioned, I've got the daily podcast, Best Real Estate Investing Advice Ever show. So I'm continually learning. That's the beauty of doing the daily podcast, is it's just a forced lesson every day from a real estate expert. I know I've had you on the show, episode 156. And it's titled Discover the Hidden Rules of Raising Private Money, where you just absolutely blow up a lot of myths that people have about raising private money. Just a very good episode. And I learned from listeners or from guests like you, that's what another one of my areas of focus.
Awesome. So, Joe, I want to give everybody an opportunity to jump in and grab some of your free information and learn more about syndication and making that transition from single family into multifamily. So where's a good place for them to either download one of your free reports or visit one of your websites?
Yeah, well, you can listen to all 350 of my podcast. They're daily. Just go to joefairless.com. That's JOEF as in Frank, AIRLESS.com. I also have a free real estate investing crash course that you can sign up for and get. And then for anybody looking to go from single to multi, I consult real estate investors. I take on 1 to 2 clients a month, and you can check that out just with the Work with Joe tab on my website.
Got it. Well, Joe, thanks so much for being here, man. I really appreciate it. Any kind of parting shots or words of advice before we let you go?
I'd say the number one thing is, the number one mantra I have is secret to living is giving. And I know if another kind of cousin of that quote is, and secret to living is giving by Tony Robbins, but the cousin of that quote is, help enough people get what they want, and you'll eventually get everything you want. So I think as long as we live by that mantra, then things are going to be great. Awesome.
Well, guys, go visit Joe and check out his information online for sure. If you have a great syndication deal and need help with it, Joe might be open to taking you on as a client. Joe, I appreciate you putting that opportunity out there for those people who are really serious and want to jump into multifamily. And guys, I appreciate you being here. This, again, is another episode of Strategic Real Estate Investor Radio. If you could go back in and jump into the podcast, iTunes universe, and let us know how we did today. Let us know if you enjoyed the interview I did with Joe. I'm sure you did. If you did, leave us a 5-star rating and leave us a comment. Let us know if there's more information, if you'd like us to bring back Joe to do a deeper dive on syndication and multifamily, or if you want us to cover another episode in the future, leave that comment for us right there. Go into iTunes or go into Google and look for Strategic Real Estate Investor Radio by Josh Cantwell. Joe, thanks so much for being here, my friend. I really appreciate it.
Thanks a lot, Josh.
Okay, guys, we'll talk to you soon. Take care.